The Fed just confirmed 111 million Americans stopped paying their bills. Your bank already saw the data and they're going to slash your limit before they tell you a single word. Here's the full story and how to stay ahead of it right now.
Tuesday, May 12th, the New York Federal Reserve releases its Q1 2026 household debt and credit report. Most coverage will run 2 days, then disappear. They'll lead with the headline number: total household debt, credit card balances, aggregate delinquency. They'll move on. What they're going to miss is buried inside the report. The Federal Reserve has already announced what's coming. On May 5th, they published a media advisory confirming that alongside the report, they'll release a Liberty Street Economics blog post examining, quote, which borrowers defaulted on their student loans and whether those defaults spilled over to their other forms of debt. The Fed itself is publishing the study that confirms a cascade is running. The financial press will report the headline. Most viewers won't know the bigger story is sitting in a companion blog post nobody clicks. By the end of this video, you'll know the cascade. The cascade the Fed is about to confirm, the K-shaped split that the aggregate numbers are hiding, the $500 billion phantom debt category. That doesn't even show up in these statistics. And what to do before your bank cuts your limit. Total household debt sits at $18.8 trillion per the Q4 2025 report. Record. Credit card balances at $1.28 trillion. Record since the New York Fed began tracking in 1999. Up $650 billion since the post-pandemic low in early 2021. A 66% increase in 5 years. Aggregate delinquency rate sitting at 4.5 to 4.8% depending on the slice, the highest since before the 2008 financial crisis. The headline coverage stops there. Here's what they don't tell you. 111 million Americans cannot pay their credit card bill in full this month. That's Century Foundation and Protect Borrowers research. Roughly 2/3 of every American who has a credit card. 27 million can only afford the minimum payment. The Bureau of Economic Analysis reported in February that personal income fell by $18.2 billion, while personal consumption rose by $103.2 billion. Americans earning less, spending more. The gap being filled with debt at 21.52% average APR. This is not a credit story, it's an income story. The credit card became the bridge between what the paycheck covers and what everything costs. 111 million Americans are on that bridge. 27 million can only pay the toll, not cross. The question is how long the bridge holds, and the May 12th report is going to show the first cracks. The 4.8% aggregate delinquency rate is misleading. It's the average of two completely different customer populations. Wall Street looks at the aggregate and calls it elevated but manageable. The split is the story. JP Morgan Chase's card services net charge-off rate ran at 3.14% in fourth quarter 2025. JP Morgan customers are prime. Capital One reported its first quarter 2026 results on April 22nd. Net charge-off rate, 5.1%. Subprime population. Synchrony Financial, which issues store-branded credit cards for retailers like Lowe's and Amazon, running at 4.8% delinquency. The spread between JP Morgan at 2.3% and Synchrony at 4.8% is 250 basis points, wider than at any point since 2010. 2.5 percentage points, two credit economies inside one set of national statistics. The Philadelphia Federal Reserve makes the picture sharper. Their Q3 2025 data shows borrowers with credit scores below 660 had the sharpest gain in average purchase volume of any group. The subprime borrower is increasing their card spending faster than anyone else. At the same time, they're already running the highest delinquency rates. They're also paying the highest interest rates. Private label cards, store cards from Target, Walmart, Macy's, average APR of 31.15%, a new series high. JP Morgan saw it coming. In fourth quarter 2025, the bank built a $2.2 billion credit reserve. Not because their own customers are failing, because they bought the Apple Card portfolio and they're pricing the risk of the customer behind that card.
Hey everyone, sorry to jump in real quick. If you want an insane deal on the Real Estate Crash Course, a bundle of 4 courses for one insanely low price, real estate crash cycles, you've got the bear market course, the real estate home seller pro, there's so much there. Check it out, links down below. Now let's get back to the video.
The largest bank in America is building capital reserves against subprime credit losses they expect to absorb in 2026. That's the institutional money saying out loud what the aggregate members are hiding. The professionals are positioning. The headline reader doesn't know yet. Now here's the part that breaks the official statistics open. The 4.8% delinquency rate doesn't include buy now, pay later. Klarna, Affirm, Afterpay, PayPal Pay in 4, the BNPL market hit $560 billion in transaction volume in 2025. 60% of US BNPL borrowers are subprime or near subprime. The same customer population is stacking BNPL invisibly. BNPL users have credit utilization on traditional cards of 60 to 66%, roughly double the 34% for non-BNPL users. 63% of BNPL users have multiple BNPL loans active simultaneously. 33% use multiple providers. Klarna for the couch, Affirm for the airline ticket, Afterpay for the clothing. At the same time, on top of cards already maxed. The Consumer Financial Protection Bureau found 34 to 41% of BNPL users report making at least one late payment. The default rate runs around 2%, but that's because BNPL providers eat the cost rather than report it to credit bureaus. The customer is missing payments. The miss isn't showing up in the credit score. The credit card statistics don't see it. The household balance sheet looks different than the household actually is. When this report comes out next week, the delinquency rate will be one number. The actual stress on the same households, credit cards plus invisible BNPL stacking plus student loan delinquency, will be much worse. The aggregate is hiding the population. The BNPL system is hiding the rest. The Federal Reserve already published the agenda for May 12th, Q1 2026 Household Debt and Credit Report, covering data through end of March, plus the Liberty Street Economics blog post. Here's what to watch for. Student loan serious delinquency surged in 2025 as missed payments began appearing on credit reports. By Q3 2025, 9.4% of aggregate student debt was reported as 90 days or more delinquent among borrowers age 18 to 29. The broader serious delinquency rate hit 5%, more than double a year earlier, the historical pattern from prior New York Fed research. When student loan delinquency spikes, spillover to credit card delinquency arrives within 2 to 3 quarters. The Q1 report captures the data through March. That's the quarter when the full student loan delinquency wave from 2025 would have had time to start showing up. The Fed's own analysis. 3 things to watch when the report drops. 1, does the credit card delinquency rate continue rising or flatten? If it ticks higher, the spillover has begun. 2, does the under 30 cohort's credit card delinquency surge? That's the demographic carrying the student loan exposure. 3, what does Liberty Street conclude? The Fed is going to either confirm the spillover or call it not yet visible. Either way, you'll know what they're seeing in the data the public never reads. The Fed is going to either confirm the spillover or call it not yet visible. Either way, you'll know what they're seeing in the data the public never reads. The Federal Reserve also signaled what's not coming to the rescue. The Fed didn't cut rates at January, March, or April 2026 meetings. The Fed is not riding to save the household carrying a balance. Here's the cascade nobody is pricing in. The sequence the data is mapping. It's already running. Step 1, charge-offs accelerate. Banks write off the balances they know aren't coming back. Capital One's net charge-off rate is 5.1%. Synchrony's is similar. The banks are already eating losses on the customer, running at 4.8% delinquency. Step 2, credit limit slashing. When charge-offs rise, banks tighten. The first response isn't refusing new applications, it's cutting limits on existing accounts. The customers carrying the highest balances relative to their limits are first. Most viewers don't know what a limit cut does until it happens. The bank reduces the credit line, your existing balance stays the same, your utilization ratio, balance divided by limit, instantly jumps. Higher utilization triggers a lower credit score. Lower credit score triggers higher interest rates on every other account. You didn't miss a payment. The bank made a decision. Step 3. Consumer spending contracts. When the 111 million people can no longer access that credit, the spending stops. Consumer spending is 68 to 70% of US GDP. The math on what happens next isn't complicated. The historical anchor is 2008, is 68 to 70% of US GDP. The math on what happens next isn't complicated. The historical anchor is 2008. In 2007, the aggregate delinquency rate looked manageable at 3.3%. By 2009, it peaked at 6.8%. The move from 3 to 7 isn't a straight line. It accelerates once limit slashing starts because the household living on revolving credit suddenly has no bridge. The move from 3 to 7 isn't a straight line. It accelerates once limit slashing starts because the household living on revolving credit suddenly has no bridge. The credit cycle has one variable the 2008 cycle didn't have. 21.52% average APR on $1.28 trillion. Every month that balance sits, it grows by approximately $2.3 billion in interest alone before a single new purchase. The minimum payment is a floor. Every month that balance sits, it grows by approximately $2.3 billion in interest alone before a single new purchase. The minimum payment is a floor. It is the documented outcome of a 6-year period in which every essential cost rose faster than every paycheck. The credit card was the bridge. The bridge has a 21% toll, and the bank that built the bridge is now looking at whether to narrow it. You're not lazy and you're not bad with money. Macro shot of a calculator screen showing 30 years. Flat domestic gray light, slow push-in. In interest before a single new purchase. The 27 million paying minimum only, watching the principal grow even as they make payments. The subprime customer at 31% APR on private label store cards, increasing spending faster than anyone else, paying highest rates. The 18 to 29 cohort with student loan delinquency layered onto credit card balances, layered onto invisible BNPL stacks. The subprime customer, watching its credit limit get cut, utilization spike, and every other rate it pays reset upward, not because of anything they did, but because the bank made a decision. Newly cleared to buy failed banks and consumer loan books at distressed pricing. Wall Street's sell-side analysts who got bullish. Institutional money saw this. Wall Street's sell-side analysts who got bullish on bank stocks while the prime customer held and will pivot before the subprime story reaches the news. The institutional money saw this 6 months ago. They're already positioned. The household holding the credit card statement is the last to know. 3 moves before the next report. 1. Know your utilization on every card. Banks cut limits on accounts with high utilization first. 2. If you're carrying a balance, understand what the rate is actually doing. 21.52% on $5,000 is $90 per month. 2. If you're carrying a balance, understand what the rate is actually doing. 21.52% on $5,000 is $90 per month. 3. Watch the May 12th report, but watch the Liberty Street blog post even closer. The Fed is publishing the spillover analysis. Most coverage will skip the blog post entirely. The blog post is the story. NewYorkFed.org/research is where it lands. The May 12th announcement will either tell you the spillover has arrived, that student loan delinquency is now landing inside credit card balances, and the cascade is moving from one debt category to the next, or it will tell you it hasn't arrived yet, which means it's coming in the report after that. The Fed publishes the data either way. The blog post lands the same morning. Whether the spillover is visible in Q1 or Q2, changes the timeline. It doesn't change the direction. What changes is whether your credit limit notice shows up before you've moved your balances or after, Tuesday morning, or read about the rate cut on your other cards 2 months later. Whether you see the bank's decision coming or open the envelope,